Good evening, everyone. My name is Fidel Mienso, and I'm the CEO here at the Midlands African Chamber. Welcome to the Midlands African Chamber's Power Hour Business Development virtual live stream, proudly presented by Wells Fargo. We are thrilled to have you join us today for an insightful discussion on financial projections. Financial forecasting provides a strategic outlook on expected financial performance, key drivers, and the assumptions behind your projections. Our guest today is Jim Reiff. Jim Reiff is currently the Executive Director of the Nebraska Enterprise Fund, a certified CDFI serving small and micro businesses across Nebraska and Southwest Iowa. Beyond NEF, Jim serves on the advisory board of Meta Fund, an investment CDIF based in Oklahoma, and also a board member of Heartland Bike Share. Jim has spent over 20 years in the economic development field, focused on micro and small business financing and development. He started full-time work in the economic field at the Northeast Nebraska Economic Development District as a loan and community development officer. He subsequently took several international roles, including the CEO role in Albania, serving over 5,500 clients, the CEO and managing director of an Indian microfinance company serving over 70,000 clients, and the managing director for Opportunity International's Latin American region of community development and business finance organizations. Jim is a graduate of St. Olaf College and Eastern University with a Master's of Science in Economic Development. He's certified as an Economic Development Finance professional. He has served in the U.S. Army Reserve and as a Peace Corps volunteer. He has two daughters, one who is an educator at St. Louis and Clark, and the other who will be graduating this May from UNL with a journalism degree. Today, we will discuss invaluable insights and practical ways on financial projections. Without any further ado, please join me in welcoming Jim Reiff. Thank you for being with us today, Jim.
Hey, thanks, Fidel. Always great to be with the Midlands African Chamber and Power Hour.
Thank you so much. Well, here we will go. Jim, you have about 40 to 45 minutes to share your presentation with us, and you may take it away.
Perfect. All right, good afternoon or good evening. I hope everybody's keeping safe. And like Fidel said, we'll just talk through financial projections. I'm going to talk a little bit of background, and then I'm going to take us through a slideshow, through a spreadsheet. That spreadsheet Fidel's going to be able to send out later, but it's free. It's an SBA score spreadsheet that I use and is really easy to use and helps you get your financial projections put in space. So how do we prepare projections? Why are we doing this? They're essential to our business plan. They help us understand the numbers, our budget, our income, our expenses, and what we're projecting. Why is this important? It helps us attract funders, both investors as well as the bank. It helps us also manage our financial health. Once we know what projections we want, we know how many items we need to sell, then we know how many items we need to sell per month. We know how many sales calls we need to get to each sale and so forth. So we'll just talk through some of the following steps that can help you create some projections, and then we'll walk through a sample as well. So the first thing, if you have an ongoing business, the first thing you can do is gather historical information. This might come from your financial statements, like your income statement, your balance sheets, and your cash flow statements. As best as possible, you want to use your historicals to help you give an idea of what are your trends, and this will help you predict your future performance. It's not always possible, but in many cases, if you have an ongoing business, this is a great place to start. The second step is really forecasting your revenue. And this is going to come in based on your market research, industry trends, and historical growth rates. What's happening in this particular field? What are you doing that makes it a niche market so you can grow faster or charge a premium or whatever else? And you'll want to consider some of the factors like customer demand, what's the right pricing strategy, and what's your competition. And by competition, just want to remind people, it's not just the direct competitor, but it's also people that, where do people spend money if they're not spending it with you? So keep that in mind. And one great resource where you can get market research free, actually there's two. OPPD has a program called Size Up. It's a marketing tool that's totally free. And NBDC and their Business Development Center can also help you with these numbers. The third thing you'll be doing is projecting your expenses. You're going to want to put your costs into fixed, like your rent, your salaries, your insurance, things that are going to pretty much stable, maybe a little bit of fluctuation based on seasonality, but they're what you have to run the business. And then you put it into variable costs. Those are your oftentimes cost of goods. And those are like your raw materials, your marketing expenses, if they're based on the percent of sales. If you have a salesperson, their bonus would go into the variable cost because they get paid more as they sell more and so forth. And you want to also make sure there's a one-time or unpredicted expenses in the budget just in case. I do this oftentimes in the legal and accounting just in case there's a legal emergency or an accounting emergency, you need extra help, you've already got it budgeted. The good news is if you don't use it, that's going to help your bottom line. The fourth step is you'll want to start to create an income statement. So you'll use your revenue and expense projections, and we'll show you how to do those in this slideshow. And we'll calculate what's your expected gross profit, operating profit, and what's your net profit over whatever period. It could be monthly, quarterly, annually. We would suggest doing month by month projections for your first year, and then either quarterly or annually for the next 2 to 5 years. So in a perfect world, if it was me in my business, I would do monthly for the first year or two, and then do quarterly for a couple more years, and then maybe annually the last year. The fifth step is building the cash flow statement. And remember, I know credit, everybody wants investors, but cash is still king. So we really want the cash flow statement, and this will help us put together and understand when might we run into problems with having too little cash. And by doing that, we're going to be able to start to predict when our cash flow comes into us. So whether it's sales, investment, loans, whatever, and when does it go out? What expenses do we have? Are they monthly, quarterly, annually? What loan payments, principal, interest, and so forth do we have? Because we always want to have at least $1, hopefully $100,000, right? After 3 years in business, but at least $1 in our bank account, so we never go into a negative cash flow position. We won't talk a lot about it today, but you want to consider what your payment terms are. Do you get 30 days, 60 days? As a new business, sometimes you can't get terms, but when you get more maturity in the business, sometimes the vendors and the suppliers will give you better terms. Are there delays both in when you pay, but also delays in when you get paid? Well, we'll pick on Corrine. I don't know if she's on today, but in the law practice, I bet she sends bills out, but sometimes doesn't get paid on time. So there's a delay in that payment cycle. And then are there seasonal fluctuations? Okay, we're coming into the spring, summer season. So if we're trying to sell snowmen and things like that, we probably won't be selling many. We hopefully won't be needing snow services again until about November or December. But we do need lawn services. So what's your seasonal fluctuation in your business? Once we're done with that, we can prepare a balance sheet. And again, the spreadsheet I'll show you will do that all automatically. One thing I do recommend, wherever you are, do fill out your balance sheet if you haven't been doing that, because that becomes a historical record. So if you're just starting a business, you want to have a balance sheet that shows your opening position. So how much money did I invest? How much did I borrow? How much did I use for prepaids? How much cash did I start with? So that's just a little secret of the trade. Remember, the balance sheet estimates your assets. I know some of you have been buying equipment over the years and are going to put that in your part of your investment. You might have to estimate what it's worth. You can look at your liabilities. How much do I owe to a bank, to a friend, to a family member? And your equity. What's my equity share? How much have I brought in of my money? And how much has Fidel brought in of her money? That would become our equity base. So you really want to get that right. And you want to keep track of it from day one so that if 5 years down the road there's ever a question, you can go back and say, this is where the original position was, and be able to delineate that. And just remember, assets equal liabilities plus equity. So that's why we call it a balance sheet. And I can show you that once we get to the slide with the balance sheet. Seventh, I encourage you to do this. It's really simple. The way I suggest, just save 3 copies of your spreadsheet, and you can make a normal scenario, which you think is realistic, but then create a best case. Stress one, put it 20% sales bigger than you think you can achieve. And there's 2 reasons you do this. One is you want to think about what does success look like and how do I get there? And 2, if that did happen, what kind of resources might you need to be able to grow? You might need more capital actually to take advantage of your best case scenario. And then you also want to do a worst case. Nobody likes the R word, but we may be heading to a recession. We may not, but recessions happen. What happens if you can only sell 75% of what you did last year? What kind of impact is that going to have on your organization? And by doing the worst case, you can start to prepare for that. That doesn't mean you have to put in plans for the worst case. It just means you have to be ready. And then 8, we always recommend your cash flow projections, your business plan. It's a living document. We want you to use it over and over. So we really want you to be able to review it, adjust it, change it. As you get more market information, you can update it, because that does 2 things. One, it's going to really help you manage your business and see where things are. Where am I on track? Where am I off track? Where did something cost more than I thought? Or what product actually brings me bigger profit than I anticipated? So that you can adapt and make sure you're maximizing your profit potential and make the relevant market changes to make sure that is happening. So by doing these step-to-steps, you're going to be able to develop a clear and actionable financial projection system that's going to really help you think through, where am I today? Where do I need to be in the next 6 months, 12 months, 18 months, and 6 or 60 months ahead, 5 years away? So it helps you start to think, when can I buy equipment? When can I do replacements? When do I need to have a new product come online? When do I need to think about an investor or a lender to help me grow to the next level, and so forth. So that's real briefly, but the key for the projections. Now, I don't know what happened exactly. I apologize. Somehow the slideshow got messed up a little bit, but we're going to talk through a case study. And I'll just read a little bit about this. It's based on a case study from a guy named Bob, and he has opened up a coffee shop called the Wired Cup. And he decided, hey, I want to set up a bakery cafe. And he's in a small college town. So let's just say, for Nebraska's sake, something like Hastings, where Hastings College is. He gets started. He's invested $30,000 of his own money. So that might have come from savings over time. He might have tapped into an IRA. He might have had a windfall, wherever. But he has $30,000 cash that he's able to bring into this. And he's also borrowed $20,000 from a bank, because he knew $30,000 is not going to be enough. I'm going to need at least $50,000. He spent already $45,000 of those on startup costs. And all of you that have done business know you can't start without spending. So He's already spent $45,000. That leaves him with $5,000 to run his business. The good news is and you'll see when we get into the spreadsheet, he's already popular with the students. University staff loves him. Neighbors like his coffee. He makes great coffee and baked goods. And in fact, one of the college deans has actually started to buy some of his croissants for the dining hall. So he's getting his business going. But you know what? He just plugged his numbers in and he's starting to look, and he's getting a little nervous. And he hasn't even paid himself yet, 3 months in, and he wonders, where's this gone? My $5,000 is gone. And given the fact that his students are our key customers are students, what does that mean? What happens if they go home for summer, and so forth? So just a few assumptions. This is the opening balance sheet. And again, I recommend you do this for your business. You can see he's current asset. He's got $5,000 cash, just like it said. All the pre-opening expenses, he spent, $250 in accounting, some on advertising, $2,000 on insurance, $3,500 on ingredients or cost of goods, a little bit on lease, some licenses and fees, some payroll, and so forth. So he spent prepaid $15,500. And he's also bought some kitchen equipment. He had to do some leasehold improvements, and he had to buy his point of sale system, and that was $29,500. So the short-term expenses, or short-term position, current assets as we call it, is $20,500. The fixed assets, long-term assets, are $29,500. That equals $50,000, just like we said in the case study. And you can't see it perfectly, but here you can see on the liability side. This is an important note. A lot of people miss it. But he has current liabilities and long-term liabilities, and they come out to be $20,000, which is the amount of his loan. But you'll notice it's $3,300 and a little bit that is his bank note. That's due this year. So he doesn't need to worry about paying the whole $20,000 in year one. He needs to worry about making sure he has enough cash flow to pay that $3,600 and whatever it turns out to be. And I've seen people do this. They say, Jim, we'll pay everything off in year one. That's great if you have profit, but you don't have to keep your lender and keep your suppliers happy. You just need to pay what is due in a given year. So think of it that way. Don't feel like I got to pay my whole $20,000 day one. But remember, you do have to pay your first 12 months in the first 12 months. And then you can see moving down slightly to equity, $30,000 of his own money. And that gives him total equity and liabilities of $50,000, which matches the $50,000 of total assets. And just some of the things you can see already, this is starting to tell us a story. It tells us how much money Bob has to run his business. It tells us he's got $5,000 going into month one. It tells us a little bit, and we're going to see even more when we do the projection, what money is moving in and out of the wired cup. Okay, we saw what he was spending on prepaids. We saw what he was spending on assets. We saw that he got $30,000 of his own money. We saw that he had $20,000 of a loan coming in. Then we have to think, where is it going? I guess that's the same question. So, and what money is moving? And we'll see it too in our projections, is when is that money moving in and out? Okay, at the beginning, month by month, at the end of the year, and so forth. So just the sake of the projections, and don't worry if you don't have all this, but this is what I used for the projections. Just took an average of drink averages, coffee. So I said probably about $5 a drink. Pastries, maybe $6. So average of 4,000 drinks in the first month and 833 pastries, growing to 42, 48.8. I got messed up a little bit by month 4, but or I guess that's the total amount. So those are just some of the projections that I used. We'll talk through what makes sense, what doesn't in a little bit. Then operating expense, I put in $50 a month for accounting. He's probably low in today's world, to be honest with you. And you would also want to think about in March or April, what's your CPA cost going to be? First 2 months of advertising were $500 and $250 a month thereafter. That's an assumption. I don't know if it's right or wrong. So something you'd want to think about is what needs to change. And the nice thing about projections, 1 month it might be lower, and next month you can make it bigger. So you can change, put in $50 of bank charges. Another place I see people forget is bank charges. Every transaction is a fee. $50 honestly might be too little for his business, but at least he started to think about it. We had cable and internet, a couple $100 a month. Again, depending what internet service, what the licensing requirements are to have cable. If he has a TV screen, that may or may not be the right. You'd have to do that on your own. Insurance, I had $2,000 monthly. Ingredients, just a guess, I had 20%, which for coffee is probably okay. Pastries might actually be a little bit higher for this projection. I did not make it higher, but I just did that. Cost of goods for restaurants on average is 35 to 40% now. With the cost of eggs, who knows what scrambled eggs percent are anymore. Janitorial, bring somebody in a couple times a week, it looks like. The lease, $1,350. Legal fees, estimate. I always recommend you put something in legal fees. If you don't have to use them, great. But I put $100 a month on average, $1,200 overall. Should be okay for his business unless he's doing a lot of legal activity. But here's a key. Make sure you do have a lawyer lined up. You don't need to work with them unless you need them. But I had one time, and I've told this story, so some of you probably have heard it, but somebody called me seriously at 3 o'clock on a Friday afternoon, and they needed a lawyer. And can any of you guess how hard it is to find a lawyer at 3 o'clock on a Friday afternoon? This was the middle of June. It's very hard to find a lawyer at 3 o'clock on June 14th. If he would have had a lawyer already, then he could have made a call to the lawyer, and that lawyer would have at least returned his call. So know who your lawyer is. We have some great lawyers across Nebraska and Southwest Iowa. You don't need to necessarily work with them if you don't need their services at the time, but do let them know that you're going to work with them if they do need help or contract review, setting up a payment system or something like that. They can be invaluable. Licensing, $1,500. Again, it's going to vary state by state, city by city, and what kind of services. Payroll tax, I put 12 to 15% in. A lot of people forget this aspect too. We as employers are responsible for Social Security and the other costs related to FICA, as well as workman's comp and some other things. So make sure that you consider that. If you're paying somebody $15 an hour, it's going to be at least another $1.50 or more of payroll taxes. So just make sure you budget that. I see too few people not budget that. And then telephone, $150, just a guess. You would know, you can base that on your own knowledge of what it costs. And then utilities, depending on the size of building, what they are, what I see, and I'm sure you do too, gas is oftentimes more expensive in the winter, and electricity is oftentimes more expensive in the summer. So what's the average? And then I kind of ballpark, but I also look and ask, is that reasonable? If you're saying your utilities are going to be less than what you're paying for your utilities at home, they're probably too low. So kind of double check, think through. And then I just had for employees, and we'll get there, year one, I said no owner's draw because he's starting up. And then 2 full-time positions at $20 an hour and 7 part-time positions at just about $15 an hour. Remember, next year it'll be required to be at $15 an hour. So we can move to, I don't know if I can move to the spreadsheet now. Make Fidel work a little bit. Okay, this spreadsheet, hopefully you can see it okay. It is 100% free, and it comes from, sorry. All right, that makes it easier. It comes from the SBA and from SCORE. 100% free, and here's the basic directions. You can see the dark orange, the darker color that's the data that you can enter. So you can see I put in, Bob prepared this for Wired Cup. He did it March of 2023. Okay, and then you can adjust the lighter colors. So the starting point. This is where Bob put in everything. He said, okay, I did leasehold improvements, equipment, furnitures, fixtures, $29,500. That's exactly the same, if you remember, that we had earlier. Then we had all the pre-operating that came out, and working capital. Cash on hand is $5,000. And that gave him total operating capital of $2,500 plus $29,500 equals $50,000. So it matches everything we did. Owner's equity, again, remember, was $30,000, 60%. $20,000 was loans, 40%. And then it talked about what the loan rate was and so forth. So, and this one is expensive, 14%. Not all your loans. Most loans shouldn't be that expensive. If you get a loan that expensive, come talk to us or Fidel or somebody, and we'll all work to get you some options that are going to be cheaper. The second tab 2A is where we put in all the different payroll. And the great thing, you'll see, he just put 2 full-time, $20 an hour, 40 hours a week, and it came up with the estimated amount. For now, he's assuming nothing's going to change. So he's assuming he's going to have 2 full-time people there all the time. He also put in 7 part-time employees, and knowing that, this is I'm right by Hardy Coffee. Some of you would know that. And so we have part-time people that Autumn hires, and he's assuming they earn just under $15 an hour, and they on average work 20 hours a week. So some might work 10 and some might work 30. So that gives us month by month and annually our payroll. So he's got $83,000 for full-time, $108 comes out to $192. But here's where you can put in 6.2% is Social Security, so that's what I plugged in. And then Medicare is 1.45%. You have a little bit of federal unemployment, a little bit of state unemployment, and then you can put in any of the other percent or amounts that you have based on what you want to. So if you wanted to give some in health insurance, you can put that in, and need to make it a percentage of the payroll. So you can see, though, of the 192, it actually adds another 18,000 of payroll taxes. That's why it's so important to project this, is make sure we don't forget it. So his payroll year one is going to be $210,000. Again, this is all self-calculated. If you get the numbers in, if you're having trouble, let Fidel know. She'll let me or NBDC or somebody to know. We're more than happy to help you walk through this. This just shows here we assumed a 10% increase in payroll year on year. Hope that's up to you. You could put 7%, you could put 2%, you could project something because there's probably going to be cost of living. And in the case of Nebraska, if you're less than $15 an hour, next year we'll all have to be paying minimum of $15 an hour. So that's just how I did that. the next one is more important, or well, maybe not more, but the way I really like this model because it lets you put in up to six different product lines. So I just put down drinks, and remember we said they were $5 a drink. We said it was $1, 20% to make each drink. Danishes, pastries, I said $6, and 40% or 20% of that comes down to $1.20. So you can put once you get the numbers per unit, it'll self-calculate. And then I put some swag. I didn't project swag yet, but we put swag in there, said $20, cost $12 to make, with a margin per unit of $8. So, and remember in the case, we had estimated average. So we sold 20,000, 21,000, 22,400, so forth. Now, we might have got it wrong. I don't know. But June, we had 23,000 of sales, but then in July it went down. Why? Because college students went home, left. August started to pick up a little bit because think about what happens. College students come back, sports start, professors start to come back at the end of August, but then by September, October, November, prices are going up again. But then I put in seasonality, a dip in December because the students they're leaving for holidays. In January, an even bigger dip because they're just starting to get back into school. Maybe they're not ready for coffee yet because they're not serious about studying until March or April and so forth. February, same prediction. Is it right? I don't know, but at least we have a starting point. Did the same projection for Danishes. So we could do that. Now, here's the great thing. Remember we did swag. Let's just say that he sells one piece of swag each month and adds one more. So we can see how easy it is. We just put in the number and it self-calculates. I'll do 2 months of 8 just because I goofed up. So you can see where it's self-calculating. So it tells us if we sell 74 T-shirts or whatever, we'll make an extra $1,480 of gross profit, and we'll have to spend $888. So we'll have a margin of $592. You could do that for as many products as you want, up to 6 products. And the great thing here, it tells us exactly. Here's the total number of. Let me see if I can make this a tiny bit bigger. You can see the total number of units sold, total sales amount, total cost of goods, and the total margin. That margin is net profit. That's what we're gonna be using to pay for all of our other expenses. So, and then the great thing, and I'm not going to go through it because you can see it, but this is year 2 and 3. So you can make any assumptions you want in year 2 and 3. And the other great thing is up here at the top, you can put in the growth rate. I put 20% growth rate. He's starting a new business. He's getting it up and going and really taking off. So this is your second and third year, or first, second, and third year projections. As we move to the fourth one, we can put in any additional, if he predicts to have additional costs, okay? So are there collections? In this case, we kept it simple. There are not collections, but if you're in a service field, you might be collecting 30 days or 60 days or 90 days out. So you could say 98% of mine are paid within 30 days, 1% are 30 to 60 days, and 1% I have an allowance for bad debt, for example. That's how that works. And then is he over the life of the period? And you can see here, I just said he'd have some equipment replacements, $5,000 a year every year. You can determine that. Maybe by year 2, he wants to add an ice cream machine. Maybe by year 3, he wants to add a second espresso machine. Whatever, you can put in what you think those will be. You could put in here on your own under leasehold improvements, maybe he's going to upskill and so forth. So, and that brings us to our operating expenses. And this is really what you're spending your every day. This is your fixed cost for the year. So advertising, how much does he spend per month? And you can plug in each of these. The other secret is you can also do a control right. If 500 is going to be every month, you do control right, it'll automatically fill. So you can put that in if there's going to be whatever kind of expenses. You can see we put insurance, advertising, insurance, legal, office expense, supplies, utilities, miscellaneous. The other thing I like to do here, I'll eyeball this and I'll look at it and say, this month is going to be more higher. So let's just say I'm looking for the accounting. Of course, I can't find it. Okay, let's just say legal includes accounting, and let's just say that in month 5, he's actually going to he'll have his accounting bill due, and that's going to be $600. Okay, so you can plug that in, and it just changes the 1 month. So you can eyeball and see, what do I need to change for that month? 5B is an extension. It's the same thing, but it gives us years 2 and years 3, and you can predict growth rate. So say you want to do advertising and you say, I'm going to grow by 3%. You can put that in and it'll self-calculate every year. This you also need to eyeball, just make sure that these numbers are still good, because what I've seen sometimes is people don't change the percentages and the projections don't make sense, because some expenses just don't increase as much as others. So keep in mind, and just eyeball it. You can look at it and say, utilities perfect. 11,700 last year. That makes sense. And it's going to grow to 12,050. Yeah, that makes sense to me. And going from 12,050 to 12,400, that makes sense to me too. So kind of eyeball it, make sure it makes sense to you and is practical. This brings us to our cash flow, so 6A in this chart. And again, most of this we had the 5,000. Now this puts in there though, and we see where it comes from. He had cash sales in month 1 of 24,500. So total cash flow in new cash was 24,000. You can see month by month what that does. I had some receivables built in there in the model, and you can see how that money is coming in. If you buy something extra in inventory, you can add that. We do not anticipate it because he's managing his supplies based on what he's selling. So we see the cost of goods sold. And this was self-calculated already from when we did our sales forecasts. So it's super easy. So in year 1, we see he's going to sell 322,000, and to do that, he has to have $65,000 of cost of goods. Operating expenses, the previous page, remember we got them all. This is just the total number, and then of operating expenses plus his payroll. And then this self-calculates his loan payments based on the interest rate and the amount he borrowed. So he's paying loan payments of just $470 a month, or $5,652 a year. Then if he was going to have a distribution, you could put in a distribution. So if you were going to pay yourself, say $1,500 a month to cover the basics, you could put $1,500 each month, and that would show up there. Then are there any repayments? So is he paying off any of his loans faster, or his line of credit? He does have a line of credit. This system is set up to help you with that. So if you run into a negative cash flow, it'll actually bring your cash flow up. So it'll tell you how big of a line of credit you might need in that. So you can see total cash flows, 27,000 first month, 28,000, and so forth. The number I also look at is on column 30. You can see it here, net cash flows, because he's lost $3,100 of cash. He's used $3,100 of cash in the first month. Second month, he's only used $1,400 more than he had coming in. But of that $5,000, he goes from $5,000 to $1,844 down to $381. He makes a tiny bit of cash in the third month, so it starts to go up. But then I also eyeball the operating cash balance to see what months am I going to be negative. So in the looks like the fifth month, sixth month, he's going to be negative. And then again, in month 10 and or 11 and 12, he's going to be negative. Okay. Now that we know that, we can think about, okay, what can we change and what can we adjust? One thing, I think if we were doing this on a big screen, all of you would probably point out, Jim, he doesn't need that many part-time people if he's not selling as much. So he could probably cut down when the seasonality is low. He could probably go from 7 seasonal part-time workers to 5 or 4. So he can cut costs there. He might be able to sell more merchandise during November and December, because why? Everybody's going to go home for Christmas. They need Christmas gifts. So why wouldn't, he'd be able to sell sweatshirts, and we can go give sweatshirts to our family members and so forth. So there's ways for him to look at this number. And again, I like looking at where's his cash balance going to be and when's it going to be negative. Okay. Because if you're positive, that means you're bringing money in, but when you're negative, that's not such a good thing. Then this did have, like I said, there's a line of credit drawdown functionality here too. So it shows how much he'd have to draw from his line of credit to stay even. Okay. And then Fidel's going to get mad at me. I'll go quick, don't worry. The same thing happens. We've already done all the cash flow. This is years 2 and 3, so you can just fill in any other changes in year 2 and 3 in terms of additional inventory, owner's distribution, and so forth. This all calculates right into our income statement, so you don't even have to change anything. This income statement will show exactly what he did. So in our sample, he sold, so his total revenue was $325,000. Again, let me see there. That you can see it slightly better. What did he do? To make that money, he had $50,000 of expenses for drinks. He had $13,000 of expenses for pastries and $888 for swag. So his total cost of goods were $65,000. So $325 minus $65 gives us his gross margin. That was $559,000. He had a payroll of that $559,000. though. He had to pay his workers $210,000. Okay, that's good for the economy, but it may or may not be good for him. He spent $3,500 on advertising, $2,000 on insurance, $1,600 on rent, $900, and so forth. So his total operating expenses were $56,000. Okay, I've heard a lot of people, $325,000 in sales. He's making tons of money. Unfortunately, he didn't make any money. He lost $7,184. So when you see that, that's where you go back to your scenarios and start to realize, okay, do I need to cut workers? Do I need to sell more? If I need to sell more, how do I sell more? And so forth. So you can see where it becomes super, super helpful on this. 7B, same thing, just calculates your 3-year income statements. And then all of this, it's already built in with this. It tells you where your balance sheet is. So by year 3, you can see he's going to have 51. If he does everything like we just showed, you have 51,000 of cash. So a little bit of inventory, a little bit of prepaids. So 54,000 of current assets, fixed assets. He's got now, because he spent $5,000 a year. He has $39,500 of fixed assets minus $14,000 of depreciation. So total assets is $79,000. That's better than where he started. The other great thing is he only owes $9,700 on his loan and $12,000 on a line of credit, and he's got $27,000 of retained earnings. So, sorry. Last two things I want to point out. With this, we have our financial projections. Now, what I would do is save this as my conservative, and then I would do one the best case and one is worst case. Just changing, and this also will help you figure out the break-even analysis. It does it for you if you get your gross margins done right, and it'll tell us he has to sell basically 29,000 of goods per month to break even, or or 326,000 for the year. And then won't go through it, but there are financials. There's tools out there. We use Vertical IQ. NBDC uses Vertical IQ and IBIS. Size Up through OPPD has this too, but you can put in the industry norms to see how he's doing compared to how he should be doing. So with that, I think there might be some questions, and any question is good as long as it's related to financial projections.
Awesome. Thank you so much for that very informative presentation, Jim. Let's dive right into some questions. So my first question to you is, why is financial forecasting a critical tool for for new business owners, and how does it apply day-to-day decision making? How does it support day-to-day decision making?
Great question, Fidel, and it's a question all of us want to be thinking about. One of the big reasons we want to do financial forecasting is to identify what we need to do to be successful. So how much am I going to sell per month? Can I reasonably sell that product? It's really easy. It's easy in the restaurant business to kind of do it. It's really easy. I see it when people do daycares, because you have so many. You can use it to how many infants can I take in the daycare? How many 1 to 5s, and how many middle school or preschoolers and so forth. So it really helps you do that. This is why we want it to be a living document as well. So every year you want to go back and check and say, did I really sell that much? Were the prices? Did I get my numbers right? I think we had $500 and some for utilities. Well, maybe you are managing your utilities and only spending $450. Next year you might budget $475 instead of $525. So you can start to really get a good grip and understand, what am I really spending? And if you're overspending, then you circle it and say, what do I need to do to manage this better if I can? Or in the case of the price of eggs, what do I need to adapt then? Because I can't, every egg now is 50 cents when, it used to be about 15 cents. So I'm going to have to change. Maybe I have to price more and move my price up or something. So it can tell us all of those things. The other thing, as you remember, we didn't talk about it a lot, but the break even is super important, because that tells you I need to sell $326,000 of product to make my break even. That means all my costs are covered by all my sales. So that's a nutshell.
Awesome. Thank you. That's a great response, especially the breaking even point, because what's the point of running a business if you cannot, number one, make a profit, and better yet, even break even, right? Because at least you want to be able to recover at least what you have invested into the business. So
and I'll go one step further, just something to think about. And it's probably not going to happen year one, but Nebraska's average salary, median household income, is about $75,000, $85,000 a year. If you're running a business, I want to see you, say, in 3 to 5 years, to be able to pay yourself at least median household income, because otherwise, why not go work for somebody? But if you can pay yourself, and to Fidel's point, be hiring people and paying people, but challenge that's what projections can tell too, is how much do I have to sell to pay myself a fair salary. And median household income is a good starting point. You might want to make more over time, but at least start there.
Definitely. And also budgeting, right? Because if you're spending so much in one area, you might need to start thinking, okay, and what can I do to lower that expense there so that, maybe I may be able to spend some of that money on in a different area. Or, if I'm not able to spend all the allocated amount that I have, then, reduce it for the next year so that you can again use that money somewhere else. And a lot of people don't think about it, but it's always better to predict or budget for a little higher than budget less, because now you're going to find yourself in a dilemma trying to figure out where should you be cutting off some of your expenses.
Exactly. I always suggest do your top line, your income budget slightly lower and budget slightly higher on your expenses for that exact reason.
Yeah. Awesome. Now, how should an entrepreneur approach revenue forecasting when launching a new business without prior sales history?
The first thing I'd love you to do, make sure the product you're selling, first of all, make sure the product you want to sell people are going to buy. So how do you do that? You go out and talk to people. You just have to do the grunt work. You got to get out there and, hey, I'm going to be selling this. What do you think? If you can't, find somebody else that does something similar, and maybe it won't be in Omaha. Maybe you have to go to Lincoln or Des Moines, but find somebody that will talk to you, that they don't feel like you're a competitor, and they'll give you ideas of how much they can sell. Talk to NBDC or use Size Up and see what the average sales are. Start more conservatively from that, because it does take time. You're probably not going to hit average day one. Also keep in mind, this is something only between 7 and 9% of all U.S. businesses sell over $1 million. So if you come in year one and say, I'm going to sell $1 million, that may or may not be realistic for your first year. We want you to get there. Trust us. That's what NEF and the Midlands African Chamber, we want everybody that works with us to be $1 million plus sales levels, but it doesn't happen year one typically. So do your research, figure out what the price is. I always tell people, because we work in rural areas too, sometimes you have to be careful because, Oakland, where our head office is an hour north of Omaha. There's 1,200 people. Somebody put a coffee shop into Oakland. Guess what? The coffee shop did do well because there's 1,200 people. There wasn't enough traffic for a coffee shop to be sustained. So think about, can my market bear both the price and the quantity I need to do? So those are some tips. It's a lot of research.
Definitely, market research is definitely important in any business that you undertake, because that's what's going to advise, what business you should try and how you should prepare yourself before even starting. So yes, that's a great point. My next question will be, what are some common mistakes new entrepreneurs make when forecasting cash flow, and how can they avoid them?
I think we talked about one of them already. That's they oftentimes underestimate what expenses are going to be. We see people underestimate what build out is going to really be if they're doing build out. So make sure you have contractors that you trust and are working with. So those are two big ones. Another one is overestimating your market, not talking to your market. Make sure you talk to the market and find out, where am I going to be? And be conservative year one. It takes time. Something's not going to go right. It's not your fault at all. It's just you're learning the business. You're getting things going. Somebody's going to break something, or somebody's going to do something goofy. It's going to cost you a little bit of extra money to undo that. By year 2 and 3, hopefully you're learning new things and making it better. But those are some. The other thing is, remember when we looked at the expenses, a lot of people don't they miss expenses. Like payroll expenses is one big thing I see people miss. Well, that's going to be at least 12 to 15% of your payroll. So if you don't put in your payroll expenses, the Social Security, the Medicare, Medicaid, unemployment, and so forth, you're going to have a big hole to make up. The last thing I can think of is a lot of people don't remember, they forget to take care of taxes. So they don't, and if you don't pay the government, guess what? The government's going to shut us down. So make sure you pay for those. Those are some common areas. All of them are relatively easy to fix and to be aware of. The other thing, it's going to be an error, but it's not really a forced error. It's something that oftentimes you can't get good terms from a supplier initially. That's not your fault, but make sure you keep that in mind, that the first 6 months I might have to pay a little more because I'm still new and that supplier doesn't know if I'm going to be around after 6 months. So keep that in mind as well.
That is awesome. That's a great advice, because there's only so much you can do. And as new business owners, the first thing most people don't do is they don't pay themselves. They're waiting, try to see how things go. They forget about taxes and so forth. And the government is definitely one entity you definitely don't want to mess with because
Not
they
at all.
will be after you. They will be after you. Let's see. Why is it important to include one-time and unexpected expenses in a forecast, and how should they be estimated?
You can, I'm going to start estimating just a best guess. I usually do it in my legal column when I do projections, because that could happen. You hope it doesn't. You hope, you saw we put $100 a month for legal. I'm hoping I would have to spend maybe $500 a year on legal, because there's always going to be a contract or something comes up. But what if? I mean, what if somebody breaks a tooth on the pastry, and you need a lawyer to make sure that the insurance is covering it properly? What if your espresso machine goes down? That's part of the reason you saw in this, we put in $500 or $5,000 in year 2 and 3, is we just said, what if there's a problem with the espresso machine? So you can kind of guess where it's going to be. Common places I put it are the accounting, are legal, or sometimes I put it in upgrades or repairs, just so you have something. And I do recommend you keep some money, budget monthly, something reasonable for repairs. If no other reason, you're going to have light bulbs you have to fix and a chair that you have to fix. They're not big expenses necessarily, but they add up. So kind of, and throw in a couple extra thousand at some place in those, just so you have that little extra buffer, is my recommendation. Again, if you don't use it, then that becomes money that's eligible for owner's draw. So you can, if you don't use it, you can always draw it at the end of the year or roll it over into your next year of business.
Awesome. Thank you so much for those detailed answers, Jim. And we're just at the end of our Power Hour series for this evening. I just want to make some announcements before we wrap up. Our Gratitude Gala awards nominations are open. So if you know anyone or any organization who is doing extraordinary work in our community, please make sure to go ahead and nominate them by July 31st by visiting our website, www.fundmac.org. Our next Power Hour is scheduled for Thursday, May 15th at 5:30 p.m. with our top 5 Pitch Black finalists. So be on the lookout as we announce who those are, so you can hear more about their businesses and how they are preparing for Pitch Black coming up on June 27th. Our tickets for the Pitch Black conference are now on sale. Make sure to grab your early bird tickets before prices go up. You can visit our website at www.wepitchblack.com. Stay connected with us through our website and our social media platforms for updates on those other events. Your participation helps us to build a stronger and more vibrant community. Again, thank you so much, Jim, for sharing your insights and expertise with us this evening. I'm sure our members have found this information extremely valuable. To our audience, thank you for joining us for this Power Hour Business Development virtual live stream presented by Wells Fargo. We hope you have found this discussion as enlightening as we did. Thank you so much and have a great evening.
Thank you.
You're welcome.